Hello fellow option traders, this is Jeff, and this video is about a possible Amazon play for earnings today. And we are going to take the position that as with many other earnings so far this earnings season, that even though they may beat the earnings per share forecast here of actually, which would be actually a, you're going to come up here and show me this here, would actually be, they're saying that they're going to lose 73 cents a share. So are they going, even if they beat that, many other underlines have beat their earnings per share forecast, but their stock price has pretty much did a very bearish move. And that has to do with almost everything that we've been looking at so far this earnings season. So I'm taking a position. We're in a downtrend. We're flat here on the weekly. So I'm saying that even though they may beat this EPS here, that they're going to say something else, or something else is going to happen. Unless, of course, the Fire phone has just like screaming, but I haven't heard too much about that. So there's a good possibility that Amazon is saying, you know what, our forecast for the next fiscal year isn't really all that hot like we thought it was, and then boom, down she goes, right? Okay, so let's look at a few things first. IV percentile, 71%. So over the last 365, the last year, the current IV, implied volatility, is 71% of the range for the last year, the high and the low for the last year. Another way that we can let's take a look at one other thing, a couple other things here. Let's take a look at today's option stats. Okay, so the 52-week IV high and low is, the high is 52 and the low is 22. So we're going to want to kind of remember that. The current IV percentile is 71%. And 43.21% for IV is 71% of this range here. So if you were to break this range up into 100 parts, 43.21 would fall into 71% of that. I hope that I made that clear. I may have screwed that up or whatever. But anyway, so what we're looking at then, we would be looking at something, A, that we can afford, and B, that we're willing to put at risk. Now there's a couple things to think about. Here we can see that this expiration period, which is this week's expiration, the IV is at 130%, and then it starts falling down, and this is like an average of all the strikes being offered. So if we were to let's take a look at the money, which right now, let's go over to the Analyze tab. I'm saying that we're looking at a 315 strike. We'll just go right here, and we can see that the October, which is this week's expiration, is 126.4%. The IV on the November 1st strike, which is the following week, is 49%. And the IV on the regular November expiration is 38 or 39%. So if we were to take a look at, I think I have to go back to the trade tab for that. If we were to go back and take a look at these option statistics here, we're saying it runs around 52 to 22. And we go back to the Analyze tab and we say, well, after earnings, what do you think is going to happen to this IV? It's going to collapse. So what you're going to end up with here, and we're looking at the 315 right here, is implied volatility. Oh, that's on November. Let's go back to this week's. The implied volatility is 126.52, like it says here. So the extrinsic value is $11, or $11, $11.50 out of this $12.70 that you're going to pay. So that extrinsic value, that is intrinsic is how much it's in the money, and extrinsic is how much time value there is, and implied volatility is a huge factor in calculating that extrinsic value. So now the risk here is, and let's go to the risk profile, and we'll take a look first at this particular option right here. Okay, so we're at 126.43%. So let's say tomorrow this drops down to, like maybe 49 or 48 or something, somewhere around one of these numbers right here. So that's taking 80 or 70 percentage points away. Okay, so let's adjust the volatility, and we'll say minus 70 and press enter. Okay, so even if price does not move anywhere at all, you lose $672, and you can't even really make anything until you get here to, like, if it drops to $303, then you can start making money on this particular strike and expiration. Yeah, you can make a lot if it drops down to $290, but the market maker move is estimated to be $23, so at best it would move $23, and $23 from $315 is $295, maybe like $290 or something like that. So you might make $300 or $400 on this thing. All right, let's go to, let's reset this back again. I think we have to, where is that? Thinking to move some stuff around. Reset parameters and date. Okay, so let's take a look at the November 1 expiration and apply the same logic to it. We're saying, what are we using, like 40 maybe as the IV for the day after earnings? So that's kind of what we used up here, so we dropped it down to 70. It was actually a little bit more than that, but let's use 40. So this one would drop 10. So we say minus 10 and press the enter key. So even if price does not move at all, you lose $335. If price makes that market move, which, what was it again? It was $23. And it goes down $23 from $315, we're saying, on average here. That's like $190. Let's say it's let's say $190. Okay, so now you're talking a little bit better. You can make around $1,200 on this. Technically, we should move this up one more day. It's not going to matter a whole heck of a lot for this particular expiration. So now we're talking, let me move this price slice here to what we're talking about. $292. So I could do this totally 100% accurate here. So we're pretty close on that. That's at $292 roughly. So let's make this here $292. And likewise, if we add 23 to 312, that's 33.35. So that's 335. 335 to the upside. Okay, so we've dropped our 10, so if it moves up, it's going to cost us almost $1,200. If it moves down, the expected move, then we'll make $1,000. All right. We're saying that basically on the November that we wouldn't change this at all. So let's clear that. Oops, what did I do here? Clear that, reset, and then we'll still go move up to tomorrow. So price stays the same, IV stays the same at 39 or 40 here. See, it's even starting to move up here on the November 1st one. So price doesn't move, we lose 48. Price drops 23, we lose 900. Price goes up 23, we make 1,200. Paying a little bit more for it, we make a couple $100 more if it makes the expected move. So which one would you do? Remember this morning, if you watch this morning's scan, I mentioned something about finding a sweet spot, and this one, the November, is going to cost a couple $100 more than the October 4th one, and only $65 more than the November 1, but you got much better protection if it moves against you. Now, you know, you could buy a call too, I guess, and try to have that offset it. But what happens if the price goes down? Then you got the two battling each other. So you don't want to. I wouldn't want to do that. I think when you're doing earnings, you just pick a direction and go with it. So what I am going to do here is I am going to lock these prices, and then I want you to check out the daily scan for October 24th, tomorrow, which is Friday, and then possibly Monday to see where we ended up on this, because when I do the scan, it's before the market opens. So there's no way that we are going to be able to tell how it's going to react during the day. So we have these pictures here, and I think what I'm going to do is I'm going to take a snapshot of this. Take a snapshot of the whole screen here, and we'll include that tomorrow morning when we take a look at it. Okay, I need to get back to where was I? I was back here. All right. And we'll take a look at it tomorrow and see how she looks. All right, I'm going to just uncheck all these so I don't get... Well, let's look at... This is the one I would do. I would do the November for $1,500. All right, so that's it. A possible way, and a way to find that sweet spot for making a directional play on earnings by just buying a long call or put. And that's how you would look at it. If you're looking on the call side, things are, most everything does apply, but things are a little bit different. Just a little bit. So, yeah, there might be a bigger crush in IV if you're playing the call side or the long side or the bullish side. All right, so this is a bearish directional play on Amazon earnings. Thanks for watching. Have a great day. Good luck and happy trading.